Hi, this is Ram Sen here. I just wanted to quickly post a Euro US dollar FX rate update from a hedger's perspective, also from the perspective of traders who trade for big picture moves. It's not going to be a fully integrated time frame analysis because we don't have long-term data on the euro, and I needed to proxy that by using the dollar Swiss. I don't have time for that right now, so I'm just going to start from the here you see once again the palette arrangement of charts running from a monthly chart, weekly, daily, 8 hours, 4 hours, 1 hour, 15 minutes, 5 minutes. So in every chart I'm zooming into the last part of the previous chart. Alright, so what we're interested in is the long-term top here, which you see in July of 2008, which is around 1.6040. Okay, and we have this decline on the long-term chart down to the low here of 103. I think this low is around somewhere around 103. Yeah, it's 103.40. Yeah, that's where the low is. So you see this entire decline from 160.40 to 103.40 from 2008, and the bottom occurring in December 2016 or early 2017, and from there you're seeing a rally. Now the question is this long-term downtrend just going to continue like this? That means that would require that the market should not go above the high of 116.17, say around 116.20, which we saw in May of 2016, because if it did, that would break the pattern of lower highs and lower lows, which we know in a simple using a simple definition is what characterizes a downtrend. So that's the question: will this break? Okay, my sense is it will break, because my sense is that a phase of the downtrend is over from this top, and so I think we have right now, what I'm playing for is a chance of a big move smashing through this high of 116.17, and also going through 117.15, which is the August 2015 high, and eventually heading to about 1.22. That's what I think is going to happen. And how do we play for that? That's the suspicion. How do we play for that with limited risk? Okay, so what you see here now, as you examine the rally that's taking place from early 2017, you see that the latest phase of the rally has started really from this low. If you zoom into this part here, you see here, which is the low basically of 30th May. 30th May we have a low of 30th May 2017 is a low of 111.09, and then you have another interesting low, which is the low of today, which is 8th of June, which is a low of 111.94. So here's the plan. Suspicion is that the euro has significant upside, and so we want to go long, and we would like to go long at market. The market right now is around 245 in New York in the afternoon of 8th of June. The market is around 112.17 offered, so you can buy it at market as well. It doesn't matter. Size your positions in such a way that you put on two positions. Okay, one, you can use a stop just below today's low, which is a low. The short-term system uses a stop below the 8th June 2017 low of 111.94, and the long-term system stop is below the 30th May 2017 low of 111.09, as you can see here. So on this chart, if you see it, what are you doing here? You're looking at the market here. You're trying to pick it up at market. Don't quibble about the entry price. Just pick it up at market, okay? Because you can always size your position to ensure that your risk is controlled. And so you pick up two lots, one for the short-term system, one for the long-term system. The short-term system stop is going to be right here. If you look at the 5-minute chart, right below the low of 8th of June, and the long-term system stop is going to be here, which is the low of 30th May. Which is 111.09. So here are the actual levels here. One stop below 111.09, that will risk 1% of account equity on the long-term system, and on the short-term system just risk 0.25% of account equity. That's good enough, because the stop is quite tight. You can still get a reasonably sized position. So this is a shot that we're taking based on a suspicion that there is potential for significant upside in the euro, and we're trying to play that by taking a stab at it with limited risk, and we'll see what happens. Okay, and I'm not going into the details once again of how I arrived at this view, because that would take too much time. But you notice once again it's a highly specific strategy. There are two stops, so if the market goes through those stops, you know that each of those views is wrong. And so the first thing we're looking for is a break above the high of 112.85, which we saw. 112.85 was marked on the 2nd of June. So 2nd of June high of 112.85. That's the first signal that our view is correct, assuming we don't get stopped out. And then eventually we move. The next big target would be 113. All of these highs that have to get taken out. The high of August 2016, the high of what's this high here? May of 2016. So one by one these should get taken out, and you should see a steady rise in the euro with fairly limited corrections. All right, good luck. Cheers. Bye.